Now, the IMF is warning not to overlook the effect of higher U.S. tariffs on global growth. It now expects the world economy to grow 3.2% this year, since tariffs, for the time being, haven't been as damaging as initially thought. Now, still, the IMF says it would be, this is their words, premature and incorrect to think these trade tensions have had no effect. Pierre-Olivier Gourinchas is the chief economist of the IMF, and he joins the program now. Really good to see you on a day when you put out quite a global outlook, and we will start there. Your outlook has modest changes, but you do highlight the challenges in the months to come from this trade friction. We just saw it on display in the last couple of hours. Do you fear that even this outlook, though, that you just published, really, is already outdated even from the last few hours? I mean, companies, governments, stock markets, they've really had to adapt to what has been an escalating trade war, principally between the U.S. and China.
Well, certainly the events of the last week and then the last few days highlight that we live in an environment where trade policy uncertainty is with us. It can flare up at any time, and this is something that increasingly households, businesses, everyone has to take into account. Now, what we're seeing in our latest report is a global economy that has been very resilient, holding the tariff shock that has been happening since the first part of the year, and with a growth number that is only slightly changed from what we had last year. And so that's a good sign. That's a sign of resilience. What we've seen is businesses have been able to adapt. There's been a lot of front loading. There is also, let's not forget it as well, a lot of trade deals that have been implemented, exemptions, et cetera. So the tariff shock itself has been scaled back down. Of course, if the shock is smaller, then its impact is also smaller. But we should not forget that we are not through this. It's only the beginning. The tariff rate that the U.S. is putting on the rest of the world is around 20%. That's not as high as in April, where it was expected to be around 25%, but it's certainly much, much higher than where it was a year ago. And the effect in terms of the impact on prices and activity, that will continue to be there. So this is why we're seeing an economy that is growing, but it's really not firing on all cylinders.
Yeah, and believe me, countries, companies have all taken notice. This has been a lot more trade friction than they even would have anticipated, let's say 6 or 8 months ago. I do want to focus on the U.S.-China trade, though. I mean, look, it is clearly having a ripple effect throughout the global economy, and that's because the U.S.-China GDP combined accounts for about 44% of all global GDP. So you have already articulated that, look, and these are your words, that the tariff shock is dimming what are already lackluster growth prospects. But what happens if this trade war escalates further? I mean, by a certain measure, it just did in the last hour alone.
Well, it just did, and who knows where it will be by tomorrow or the day after tomorrow. So I think this is where we have to sort of step back a little bit and think about the risks that this represents. We try to assess them in one of the scenarios that we prepare for our outlook. We have a baseline projection, that's the 3.2% growth number we expect for this year, 3.1% for next year. We'll also try to think about what might go wrong. Among the things that might go wrong, obviously, an increase in trade tensions, that would certainly weigh down on global growth. Disruptions in global supply chains, that would also weigh down on global growth. Now, we don't have a crystal ball. We didn't really try to simulate the effects of the kind of disruptions that people are talking about right now. But even reasonable expectations about potential trade disruptions would shave off maybe 0.2, 0.3 percentage point of global growth next year. So that's quite significant.
It is significant. In fact, some would say, especially given the position some governments are in, even alarming. I do want to get to what you say are the 4 potential downside risks to the global economy, and that includes the AI surge, the risk profile for China, sovereign debt, and institutional credibility, and that has a lot to do with the independence of those very crucial institutions, things like, the central banks in all countries. I have to ask you, which one worries you the most? Because you could say, all things being equal, is it China? And not just its relationship with the United States, but its own fiscal management.
Well, the situation in China, from our perspective, is certainly a source of concern. What we're seeing is an economy where the domestic side is stuck. There has been a real property sector boom and bust, and they haven't really cleaned up that property sector, so it's weighing down. Households are very uncertain about the future. There is a lot of savings, relatively little consumption. Businesses are very worried about what might be happening. So domestic demand is very weak. And so for the last few years, this is an economy that's been growing mostly out of its export sector. It's been doing a lot in that space, and it's been helping the economy grow. But we see the limits of that. We see we're in an environment in which we have these trade tensions. They cannot be ignored. And of course, there's been a lot of redirection of trade. China is trading a lot less now with the US than it used to be. It's trading a lot more with other Asian economies and a lot more with Europe. But there is a limit to how much it can hope to lift its own economy through just the export sector. And so that's why we have some concerns about its growth prospects going forward.
And if we talk about what you call the AI surge, in your words, it offers both promise and peril. There is risk there. And you point specifically to a market repricing. How real is that risk right now?
Well, one is to be careful about what might be happening in that space. We have the episode of the dot-com period, 96 to 2000, where there was also a lot of optimism about a new technology. That was the internet then, and a lot of investment, an increase in valuations. People felt richer. People went out and consumed. The economy was doing great, actually so great that the Fed had to tighten policy rates during that time to try to contain price pressures because demand was very, very strong. And then we had a market correction. That market correction led to the 2001 recession in the United States. And so I think we have to look at these episodes. I'm not saying we are on the same trajectory necessarily. No one, I think, can tell for sure what might happen. There are, as you pointed out, there are productivity gains with AI. Everyone is using it. I'm sure you're using it. I'm using it. Everyone can attest to its benefits. But we have to be concerned about the valuation that the market is putting on this right now and whether there might be excess optimism, and be careful about how this might unfold if there is market repricing.
Yeah, and I'm sure you've heard from CEOs as well as I have, and you see in the data that at times, certainly the productive rate of AI is not matching the capital investment, and that's what's key there. I do want to get to another issue, though, that kind of relates to this, and that's inflation. Some people are saying 3% is the new 2%, right? What is your feeling about, is it unrealistic in developed economies to try and bring inflation to 2%? And you say very clearly in the outlook that, look, inflationary pressure is still here.
Well, yes, and I think, some parts of the world, advanced economies are back at 2%. You look at the euro area, in fact, their inflation is even at 2%, in some of the countries in the euro area below 2%. There's nothing that cannot be done there. I think the interesting question is, why has inflation been so persistent when we're looking at the US? There's been relatively little progress that's been done in a year in bringing down inflation. Now, our assessment is some of it is related to the tariff shock that is feeding into higher prices. Not fully yet. There's more to come in that space. And that's why in our projections, we're expecting inflation to remain persistent in the US and above central bank target. Now, that is something that is obviously a concern if you're, a member of the board of the Federal Reserve, where you have to bring back price stability. And we've seen this, this inflation running higher than target for some time now.
Pierre-Olivier Gourinchas, we thank you, and we'll look forward to another interview at the end of the year so we can take the full measure of 2025. Thanks so much.
Thank you.